Hi, I'm here today with Dr. Barbara Kiviat from Stanford, and we're going to talk a little bit about how credit scores are used in the US. So thank you so much for joining us. And to start it off, do you mind telling us a little bit about your background and why you got into credit scores in the first place?
Absolutely. And first, let me just say thanks so much for having me here. This is such a great topic, and I'm thrilled that you folks are having this set of conversations around it. So I used to be a journalist before I became an academic. And in my transition from journalism to the academy, at a certain point, I had a temp job doing some research assistant work for an economist. And in order to get put on the payroll for a job that I already had, I went to a temp agency, and as part of the paperwork they wanted me to do was something they were asking me to sign in order so that they could pull my credit file, my consumer credit file. It was a disclosure notification, which is required under the Fair Credit Reporting Act of 1970. And I didn't know why an employer would want to see my personal credit data, my month by month history of paying my credit card on time and so on. So I didn't sign it, because I was not going to give them permission to look at that information about me. And I was pretty quickly told that I had to sign it, that it wasn't really an option for me not to sign it if I wanted to be employed. And so I held on to that experience. And later, when I was a PhD student in sociology, I returned to that because it was actually puzzling to me why employers would want to look at my credit file in the first place. I genuinely just wasn't entirely sure, given that I wasn't applying for a job, in finance, say, how that was relevant. So my first paper on the use of credit data and scores in non-lending settings was based on interviews with about 60 hiring professionals who used credit data in making hiring decisions. And so that was how I got into it. And from there, I've now also explored the use of credit in other non-lending domains, insurance, especially car insurance pricing. I have one project that we're just starting to write papers from about how landlords look at credit reports and making decisions about who to rent to, and so on.
Cool. So based on your research, can you elaborate a little bit more about why exactly employers would want to look at credit scores, and also if there's places where they maybe shouldn't look at credit scores?
Absolutely. So I always think of them as like organizational gatekeepers or decision makers. So, hiring professionals or insurance underwriters or landlords, these are people and organizations that are basically making decisions about who gets what, who's going to get a loan and what interest rate, who's going to get an insurance policy or not, who's going to get a rental, apartment or not, who's going to have to pay a higher deposit. So I think one thing that's important to understand is that each of these sorts of organizational gatekeepers is often coming from a slightly different direction in terms of why they want to use this information, and then also how they use it. So insurance companies, for example, look at credit scores. They look at all this data combined down into one single number. Employers don't. They basically look at the raw credit data, I think, for a variety of reasons, including legal liability. So what employers are doing is they're looking at your raw credit file, which can be multiple pages. And basically what it shows at the top is, your name, your address, maybe any past addresses you've had. Sometimes there are past employers on there. And then it shows you have, this MasterCard in January, February, March, April, and so on. Did you pay it on time or were you late? You have this car loan. You have this mortgage. You have this student loan. It shows if you have been party to some sort of legal action involving money. So if you've been in small claims court and there's been a judgment that you owe someone money, that's going to be on your credit report. There's another whole section that shows who else has looked at your credit report. If you've been applying for a bunch of loans, that's also going to show up on your credit report. So it's very long and complicated information that employers are basically trying to make sense of. And what they're generally doing is using this as a measure of one's moral character, whether or not one is trustworthy, sometimes with respect to jobs that have to do with money, but a lot of times not. A lot of times it's just a more generalized sense of, is this a person who can be trusted? Hiring can be a really scary thing. You're bringing, someone who's probably a stranger into your organization, and letting them have access to all different things. So employers want to know, are these, going to be trustworthy people? It's far less common that employers would be thinking about this as some sort of skills test. So going in, I thought, well, maybe they want to look at this because they think somehow this is a measure of, competence. That came up occasionally in my interviews for hiring for certain types of jobs, but in general, not. It was really sort of a more qualitative assessment of, is this person trustworthy? So then what employers are doing is sometimes they're using sets of rules, sometimes internally they come up with, well, no more than 3 past due debts, or no more than X dollars in delinquency. In those cases, we wouldn't hire the person. But what also often happened was just sort of case by case, employers were telling themselves stories about this person's financial situation. And then in many cases, calling up these job applicants and asking them, oh, I see you have these credit problems. Can you explain this to me? And then what would often determine whether or not the person in fact was hired was how convincingly they explained away these financial blemishes on their record.
Yeah, that's really interesting, because a lot of times, like poor credit can be the result of untrustworthiness or reliability, but it can also just be a result of like going through hard times. And it's nice to know that at least some employers are actually like trying to figure out which is which, because
Exactly.
otherwise, I could see that really posing an issue.
And that's what drives a lot of them trying to basically get to the bottom of it. And I should say that employers tend to look at credit towards the end of the hiring process. They've already sort of decided here, this is the person, or these are the 2 or 3 people who are most interested. So they've already invested a fair amount. So it's sort of in their own interest to, not immediately throw a person out and do a little bit of digging. If they were using this as like an initial screen, like a resume, that might not be the case. I could easily, if this was just sort of an initial screen, they might not care about the story. But they do, since this is sort of a moment in the hiring process when they're already invested. So they do often call people up, or just looking at, where the delinquencies are coming from. They tell themselves, stories about, oh, well, this person went to an expensive school and took out all this money, then there was a recession and they couldn't get a job. That's maybe about the broader situation, not their own moral character. Or maybe this person, there's a sense that this person, seems like they were an entrepreneur, they started a company and that didn't work out, but they, sort of use their personal credit. Do I really want to sort of, not employ someone who had that amount of initiative? And so this is why they call people and get stories. The potential problem is multiple. So one, in these situations, what if you don't want to share your personal financial details with your potential employer? That doesn't work. If an employer calls you up and says, look, I want to hire you, but you got to explain this to me. And you say, that's a personal issue. That has nothing to do with my ability to do the job. I'd rather not discuss that. You're not going to get that job. Right. So part of this is, it is sort of a good impulse, but then you're also perhaps, making people talk about things that, some would argue don't have any place in a job interview, especially if, what if you have all those credit card delinquencies because you got divorced, because you got in an accident, or you got really ill, you didn't have health insurance, or maybe you did, but you still, had to pay out of pocket, tens of thousands, if not hundreds of thousands of dollars. So it sort of has this, potential effect of bringing, things about people's lives into the employment conversation that maybe they wouldn't.
Yeah, maybe like, what if you had pre-existing medical conditions that you didn't want people to know about?
So it opens the door to people explaining why this, pattern of data doesn't reflect poorly on me, which I think a lot of people would think is a good thing, but it also opens the door to other dynamics, like, basically, potentially, I think some people would say like an invasion of job applicants' privacy. And then there's also the issue of, is everyone sort of equally able to tell the story that employers want to hear? So, not everyone is necessarily, as high on what sociologists call cultural capital. So, most hiring professionals, people in HR, this is a sort of job that most people have a college degree for. These are people that are sort of in a particular position in the class structure. So if you're hiring for a job that maybe just requires a high school diploma, people might have different understandings about what employers even want to hear, or how they're supposed to account for things. In this paper I wrote, I call it like a moral redemption dance. Like it's very tricky, because what employers generally want to hear is, this wasn't my fault, but I take full responsibility for it. There's like this paradoxical thing where you sort of have to perform, to get out of this, bad mark of a credit record is like, look, I'm going to take responsibility. I was the one that didn't pay the bills, but at the same time, that wasn't at all my fault. That's a contradictory message, which, different people might have a different, ability to sort of realize this is how you're supposed to play the game, so to speak.
Or even like just a different ability to express that.
Absolutely. And that doesn't even get into, so my data for the interview-based study were based on interviews with hiring professionals. So this is, from those data, I can't confidently say that there were differences in how this played out by things like a job applicant's sex and race, because I wasn't observing the job applicants. And as a social scientist, you always want to be careful not to speak beyond your data. But after that study, I did another one with a colleague where we basically gave real life hiring professionals resumes, which we designed, and packets of information about job candidates, and then asked them, how likely would you be to hire this person? If you did hire this person, how much would you pay them? And these job applicants were exactly the same, except for three things. They either had good credit, bad credit, or no credit. They were either Black or white, and they were either male or female. And what we found through this experimental method, which is much better at sort of pointing to this sort of causal effect, is that the same exact bad credit record was seen as worse when the job applicant was Black versus white or female versus male. So there could also be some various sorts of biases working in the background that employers might, be more or less forgiving, not just based on how well a person tells the story, but, other things that they know to be true about this person. That was an experiment. You always want to be careful generalizing too much to the real world from such an artificial setting, but it's definitely suggestive evidence that there are multiple doors that this practice opens that might lead to less than desirable hiring practices and outcomes.
And speaking of those less desirable outcomes, I noticed in another one of your papers, you mentioned that I think 11 states had actually either like restricted or completely gone away with employers' ability to use credit reports. Do you want to, do you think that's a good thing? And if so, why?
Sure, and it could actually be more. I think a number of cities have also instituted such bans. So I think it's a complicated thing, because actions can have unintended consequences, and there's a much bigger literature on preventing employers from seeing job applicants' criminal records, and there's some evidence to suggest that if you take away criminal records, that actually hurts Black job applicants, because the theory is employers sort of start reverting to unsavory stereotypes about who is likely to have a criminal record if you don't actually let them see that. So there is a chance that if you take this information away, they might start reverting to assumptions about people. So the tricky thing, I think, is, and the important thing to realize is really unpacking why employers are looking at this information in the first place. So if you're so I have a lot of empathy for people hiring. It's a really tough, scary thing to do, to make decisions about who you can bring into your organization, especially if you're giving them any sort of authority or power. So I have a lot of respect for all the hiring professionals I interviewed who are really just trying to do their job. So if you're a government legislator and you're worried about this, one thing I'll point out is that at least a subset of employers are looking at credit reports and other background checks because of governmental regulation and policies. So we live in a world where it's a very sort of like legible signal that I've done my due diligence, in making sure this employee is safe if I've done a background check. And a background check can include multiple things, including credit and criminal. So employers are sort of in this ecosystem where lots of different entities, including governmental bodies, are saying like, oh yeah, do your due diligence. This is how you prevent things like legal liability, do the background check. So what I would say is, if there's a government body that, that really cares about this not being, permitted, that one thing to definitely take a really hard look at is like what actions of government might be, sort of pushing certain employers towards this practice in the first place. So certainly any regulated industries. So banks are a really good example. When I was interviewing employers, and I found very similar things interviewing executives of insurance companies who use credit scores and car insurance pricing, is there were always a subset that didn't want to do this, but they felt they had to. So for employers, this came up a couple of times with people that worked at banks. And as one person explained to me, the Federal Deposit Insurance Corporation that basically secures the deposits, sort of as a backstop to like ordinary retail investors' money in banks. So if the bank blows up, you don't lose your life savings. This organization that runs this program basically tells banks that they need to make sure that they're hiring people who are financially responsible, which seems legitimate. They don't tell banks how to do that. They just say they have to. And so basically, the hiring people in banks sort of feel like, okay, well, I don't know what exactly that means, but I know that if I run a credit check and you pass a credit check, then I've, crossed my T's and my dotted my I's. And this is like a very sort of like institutionalized way of articulating that someone is financially responsible. There might be other ways of doing that. So I think that with all policymaking, it's really important to understand the perspectives of those who you're going to start regulating. In this case, if you're going to take something away from employers, you really want to understand, well, why are they using it in the first place? And sort of sometimes there might even be other mechanisms you can act on besides bans. One sort of telling of why credit checks became so popular was that lie detector tests actually used to be more popular in hiring, going back to the 70s and 80s, or not in other sorts of like honesty tests. But then they were sort of found to be legally problematic. And so if you sort of think about employers have a problem, they want to make sure they're hiring trustworthy people. It's fine if you want to take away, credit checks introduce lots of inequities and inequalities. It's fine if you want to take that away, but if you want to be really conscientious, then you want to really ask yourself, okay, then what are employers going to do next? Or how do I want to help them not replace this with something that I also have a problem with? This is why I'm an academic and not a policymaker, because I'll just talk pros and cons all day long, and it's, you can't pin me down on a policy recommendation. That said, I'm very empathetic to the impulse to get rid of credit checks in hiring because of the many stories I've heard from real folks who wind up, especially in certain industries that are heavy users of credit checks, not being able to get a job for months or even years on end. Bad credit can really devastate people. We saw a lot of this after the Great Recession with the foreclosure crisis. And a lot of people in finance, their credit was wrecked. To the extent that was any one person's fault or not their fault, I don't know, but it does mean that a lot of people basically then couldn't get hired, in their own industry again.
Cool. So shifting gears a little bit, you also mentioned use of credit scores in insurance. Do you want to elaborate a little bit about that and maybe more possible issues or reasons to do it?
Sure. So employment and insurance are really different because from what I can tell, and I haven't looked at it closely in the past couple of years, but no one's ever really shown me good evidence. I've not been able to find good evidence that aspects of credit reports predict how well someone is going to behave on the job. That sort of like mathematical correlation or statistical validation, from what I can tell, is pretty much entirely missing when it comes to credit reports and employment, which is, I think, one reason why people get upset about them, which is you're doing this and I don't even know that it works. It might be one thing if it was really good at like weeding out, the problem employees, but I'm not even convinced that. So in insurance, it's a really interesting case because credit scores definitely predict mathematically the thing insurance companies are interested in, which is how likely someone is to file an insurance claim. So insurance companies want to know this because if people file an insurance claim, then they cost more. And so in most, not all, but most lines of insurance, we have risk-based pricing, which means people who are riskier or who are predicted to cost companies more are expected to bear the brunt of that risk themselves financially and pay more. There's a much older conception of insurance, which is you're supposed to be spreading risk out across people. And depending on the sort of insurance, people would argue that you need either more risk spreading or more risk assessment. I like car insurance pricing because unlike some other lines of insurance, especially like health insurance, pretty much everyone agrees like the market can handle car insurance, right? Like reasonable people can disagree. Is health insurance a purview of the market or the government? But in car insurance, no one's really arguing that, this should just be, companies should be able to price this in the market. So credit scores, which started being used in car insurance pricing in the like late 80s, early 90s, I would say, are really, really good at predicting insurance claims. And I should be clear, that's different than who gets into a car accident. So basically, when we say risk, I think to an ordinary person, if you think risk in car insurance, it's like the bad thing that could happen is getting into an accident. But from the perspective of the insurance company, that's not the bad thing. The bad thing is you get into an accident and then you ask me to pay for it. So lots of people get into small fender benders, and those who are lucky enough to have the resources to just fix things do because they don't want to see their insurance rates go up the next year. So credit scoring starts being used as a rating factor in car insurance pricing. And there are a few companies that sort of are early movers on this. Fair Isaac, which is the big credit scoring outfit, has its own line of what gets called credit-based insurance scores. And public policymakers, regulators at the state level, and then state legislators as well, basically for the past 30 years have been having this debate about whether or not this is fair. And it's an interesting one because scores are mathematically predictive, and there's a long history in car insurance pricing in the US that says, data that are predictive of insurance claims are fair to use. Credit scores are very predictive, yet there's this continued contestation. And, in my research, I argue that this is because you can wind up with a bad credit score for very different sorts of reasons. And so what you see over the decades is a lot of state legislatures pass laws really restricting the use of credit scores in car insurance pricing, essentially because they come to see that there are some legitimate reasons that you have bad credit and some not legitimate reasons. So if it wasn't your fault, if it was, you got, deployed for military service and you just, miss some bills, do we really want to be, like driving up the insurance rates, of the guy or gal who's been, been deployed, that should sort of be an exception. And a lot of state laws have that sort of as a carve out, as an exception. As a car insurance company, you can't hike up someone's rates if that's the reason they have bad credit. Certainly things like divorce, job loss, medical travesty as well. So what you see is people are making all these fine-grained distinctions, two people who have the exact same credit score. So in terms of the math, those people are identical, but basically what all these policymakers are doing is saying, but they're not really identical. They might be mathematically identical, but morally they're really distinct. This person just like chose not to pay their bills, like raise their car insurance rates. What do I care? Like that's going to be your penalty. But there's this whole other set of people that legislators in lots of different states feel like it's not right to penalize you in the car insurance market, because you had these various sorts of bad fortune. And then in these debates, there are also, and increasingly in more recent years, issues of race and ethnicity as well, because there's a very unfortunate and long history of predatory lending practices and so forth in this country, which still reverberates through a lot of people's credit files. So that's sort of another line of reasons why maybe the horrible credit isn't entirely your fault, is because you are subject to sort of systematic predatory lending practices.
Is there, so the insurance uses specifically just the credit scores, you said, right? So that's just like a number. Yeah.
Credit scores are endlessly fascinating. So no one has like a credit score. Basically, what a credit score is there are credit bureaus. So the big three are Experian, Equifax, and TransUnion, and they have these massive databases of information about individuals. They might have like thousands of fields of data about people. So what a credit score is essentially like the mathematical result of like one query of that database. So when you query that database and what combination of those fields you query will lead you to have a different score. So car insurance is also different in that the outcome that they're trying to predict isn't, you defaulting on a loan, but you filing an insurance claim. So the development of credit scores, which took many, many years and a lot of hard work. It was an accomplishment, in many ways, because essentially insurance companies had all of the data about claims, and lenders and the credit bureaus had all of the data about credit events. And so you have to merge those two data sets. And so in insurance, they're specifically predicting the insurance outcome, not the lending outcome. So there's this big sort of discursive battle over what to call these things, because people who think that they totally should be used in insurance don't like just calling them credit scores, because even though it's credit data, they're predicting an insurance outcome. And so sort of the rhetoric is that they're credit-based insurance scores to sort of underscore that this isn't about using credit data to predict a credit event, that it really is, at least on the prediction side, in the domain of insurance.
Yeah, I can see that, because it makes it seem more connected, not like you're just using this totally unrelated number.
Exactly. And I think that I also have a line of research that uses nationally representative surveys to ask everyday people about how they assess the fairness of using different sorts of personal data in various sorts of decisions, like insurance pricing, like lending decisions. And one thing that emerges from that work, which is interesting, is there are different ways to think about what it means for two things to be related. So a lot of the argument around credit scores in insurance pricing, and they're starting to sneak into life insurance as well. They started with property and casualty and car insurance, homeowners, renters. They're starting to move elsewhere as well. So does it mean what does related mean? You know, that this data is related to this insurance outcome. Does related mean that there's a mathematical connection, that I can create an algorithm, you know, that sort of mechanically connects, you know, this input and output? Or is there another standard that needs to be met? Is that sort of mathematical relatedness just sort of, you know, is it maybe necessary but not sufficient? And so you see this come up again and again, that people sort of think like, well, they're not really related. And what they're essentially saying, I would argue, was that they're not logically related. They're not connected in like a theoretical or commonsensical way, and that's a problem because of how we morally evaluate things. That you know, in order to decide, you know, sort of the moral content of something, we often, you know, want to know things like, well, why does this work? You know, that's sort of part of our like moral, how we're wired is moral.
Yeah, it's sort of like a correlation versus causation kind of thing.
Animals, exactly. And one thing that's interesting is that when you see this in the credit scoring debates, is that sometimes people think like, okay, so it may or may not be fair to use things that correlate, but if there's a causal relationship, if one thing's actually causing the other, then it's fair. And what I find is it's not quite that cut and dry. Some causal explanations pass moral muster and others don't. So basically what the causal reasoning is doing is helping you decide whether or not this is a fair practice. So for example, in the car insurance debate, one thing that you see come up time and again is if you think that low credit scores go with more insurance claims because irresponsible people both don't pay their bills on time and drive worse, like lunatics, if like responsibility is sort of causally related to both, then people tend to be more on board with the legitimacy of that practice. But you can tell another causal story, which is, well, maybe like lower income people both have lower credit because they just don't have enough money to pay their bills. So there's a causal connection there. And they also file more insurance claims, not because they get into more accidents, but if they do, they have to file a claim. People who aren't in a position of privilege to say, oh, it's just like a $300 fender bender, I'm gonna write a check to the mechanic. There are lots of people that don't have $300 in the bank. So there, it's also a causal connection, but what's driving it isn't, you know, someone being personally irresponsible, but someone being poor. And so for many people in these debates, that's a little trickier. You know, if why this works is because it's, you know, raising prices for irresponsible people, it's like, if why this works is because it's raising prices for poor people, then it's like, well, hold on. Is that something we want to do? Or so many people in these debates argue. So it's not that causal connections are past moral, you know, standards and non-causal ones don't, but the actual causal connection is part of how we morally reason about what is fair and what isn't.
Oh, it's really interesting. So is there anything that like everyday people can do to help try to essentially mitigate these possible negative effects of using credit scores or credit reports?
Yeah, it's really tricky because I think that being aware that these various sorts of gatekeepers might be looking at credit data, and if you do have blemishes in your record, just to try to get out ahead of it as much as you can. So, you know, if you're, you know, applying for an apartment or a job, to try to, you know, get those, you know, people in those organizations to work with you, but you're going to have more luck in some types of organizations than others. So, you know, our work on landlords and property managers, if you're applying to rent a unit at like a really big corporate, you know, entity, you know, you're much less likely to get someone who can sort of work with you and like hear your story and take it and maybe make adjustments. For a lot of the car and homeowners and renters insurance pricing, most companies do have policies on the books that if you've sort of experienced any of these what they call extraordinary life circumstances, that they'll sort of take your credit score out of the calculation. So definitely for insurance, it's always worth going on the website and finding out, where you can, contact to sort of make the claim that, well, this credit problem is because of, my divorce or my, medical treatments, and try to get an exemption. It's really tough though. I mean, more broadly, as with everything else, like, talk to your state legislatures. I mean, one of the nice things about all of these really domains we've been talking about is that states do have a lot of authority over how these various gatekeepers use credit and other sorts of data. And so in the work I've done around the use of credit data in car insurance pricing, over the past few decades, there have been lots of instances of legislatures picking up this issue because they get calls from either consumers that have seen their rates skyrocket, or in some cases car insurance agents. So there's often, as a citizen, you often have a much greater ability to affect change at the state and local level than you do at the federal level. So in this context, I think that's good to work the phones and to let your elected representatives know what your concerns are.
Cool. Last thing is there anything else that you wanted to make sure gets said on this, like that hasn't been covered yet?
Yeah, so the reason why I have been able to study credit data and scores to the extent that I have is in part because in 1970, Congress passed the Fair Credit Reporting Act, which gave individuals rights when it came to their credit data, including, for instance, I have a right to see my credit record. Like Experian doesn't get to tell lenders a bunch of things about me, without my knowing it. I have a right to be able to correct mistakes in my records. I mean, how well that actually works in practice is a good question. So credit data in the United States is there are a bunch of consumer protections around it that basically don't exist for many other types of data. So a lot of the things that we're talking about here are about credit data specifically, but they could apply to other sorts of data, especially as sort of the big data world we live in, grows more and more. So, medical data is another sort of special category of data that has some protections around it, and educational records. But the way this regulation has happened in the US versus lots of other parts of the world is sort of like one sector at a time. So because of law and regulation, there have been discussions. So I think that's one thing that's important to think about, that a lot of times what sort of having oversight of personal data does, it's not just about telling companies what they can or can't do, but it's just making issues visible so that people can have conversations. And for many other sorts of consumer data, that's just not the case in the US. So that might be the sort of the bigger thing, that if people want to take up sort of a consumer activist approach, is to really think about credit data gets studied a lot. It is important in and of itself, but it's also visible. But that's not by chance. It's visible because certain laws and regulations have made it visible.
Cool. Once again, thank you so much for joining us. And that's all for this time.
Yeah, thanks so much for having me.